Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. We are on Fed Watch, where we just got a 25 basis point stocking stuffer. Yes, it's that time of year again, and Powell & Company had to make the decision whether to give the money and bond markets a gift of cheer or a lump of coal in their stocking. And at the December FOMC meeting, the Fed decided to give investors that quarter-point rate cut as a stocking stuffer. So this latest easing move was widely expected, and now it brings the new Fed funds trading range down to 4.25% to 4.5%. And now comes the more uncertain aspect of the easing cycle as we move into 2025, and that's the pace and magnitude of any potential future rate decreases. In a highly data-dependent monetary policy world, it leaves plenty of room for further speculation going forward. But, as we get ready to close the books on 2024, it does appear the Fed may not necessarily be cutting rates at successive FOMC meetings, as had been the case since the policymakers began this process back in September. And one important aspect that comes to mind is the visible difference in the narrative that's accompanied the December FOMC gathering as compared to what we saw back in September. Now, 3 short months ago, the Fed and by extension the money and bond markets were operating under the assumption that the economy and labor markets could be cooling more than previously expected. And disinflation was continuing, which would result in an aggressive Fed rate cutting cycle. At one point, actually, the implied probability for Fed funds futures was looking at a 2.8% target by Q4 of next year, and Treasury yields had plunged by 100 basis points. Now, recent economic numbers have revealed a continued resilient economy, labor market showing signs of not being as cool as originally thought, and the inflation numbers have hit a roadblock. So needless to say, these developments completely change Fed rate cut expectations, with Fed funds now being discounted to be at about 3.8% by the end of next year, and Treasury coupon yields all being back well over the 4% threshold. So where do Powell & Company go from here? The Fed chairman reiterated that policy's been recalibrated with the goal of becoming less restrictive and moving the Fed funds target down to neutral territory, data permitting. And that's where the uncertainty comes in. What's a neutral Fed funds rate? In our opinion, the level is now higher than what prior Fed estimates had been showing, and at a minimum could be at least 3.5% or maybe 3.75%. Now, I think the policymakers seem to think the neutral rate has risen as well, but what the Fed decides is the appropriate level may be a moving target in the months ahead. Now, if the voting members do follow through on bringing the Fed funds target down to those previously mentioned neutral readings and they stop easing there, that would mean there's potentially only a couple of rate cuts for 2025. And one other policy aspect to be on the lookout for from the Fed is their plan for quantitative tightening, or QT. The Fed's already tapered their pace of balance sheet reduction, so it wouldn't be out of the question at all if the next step in the months ahead would be to end QT at some point in 2025. So at a minimum, what's the bottom line? A reasonable case scenario could involve the Fed taking a pause to reassess things to begin 2025. Now, that doesn't necessarily mean the rate cut cycle would end, but the policymakers have already cut rates by 100 basis points. So perhaps Powell & Company taking stock could make some sense. I'm going to end it there. I hope everybody has a great rest of the week. Take care and be well.